9:47 MEST, March 14th. COMEX silver futures trading floor. The bid-ask spread just exploded to $5.20, the widest gap in over a decade. Screen price jumped from 30.50 to 35.70 in 5 minutes flat. That's a 17% spike in 300 seconds. COMEX registered inventory hit a record low, 100,000 ounces. Pull up any major dealer site right now, 100-ounce bars showing out of stock across the board. Physical premiums spiking 25% over spot while paper futures hold steady on your screen. The divergence is impossible. While electronic contracts trade smooth, actual metal has vanished from dealer shelves. One major bullion site posted, "No inventory available, allocation basis only." This isn't normal volatility. This is a $5.20 gap that shouldn't exist in a functioning market. The math doesn't work anymore, and the system's about to buckle under the weight of what it promised versus what it can actually deliver. By 10:02 a.m. Eastern, the reality of the gap became undeniable. COMEX futures settled back to 33.20 after the initial spike, but physical dealer quotes stayed locked at 35 plus. The arbitrage mechanism that's supposed to close these gaps? Dead silent. Institutional desks that normally pounce on $2 spreads weren't touching this one. Why? Because you can't arbitrage what you can't deliver. One floor trader described it as watching a bridge collapse in real time. The connection between paper and physical just snapped. Check the order books. Bid-ask spreads on physical silver widened to 280, 15 times normal width. Volume on COMEX remained elevated, contracts still changing hands, but try converting those contracts to actual metal and the system seizes. The electronic price showed recovery, the physical market showed panic. If you're holding paper silver, ETFs, futures, unallocated accounts, the physical world is closing the door on conversion. This gap isn't temporary volatility. It's proof the delivery mechanism is breaking down in real time. The discrepancy had historical precedent, but this time felt different. In 1980, the Hunt brothers drove silver to $50 before COMEX changed margin requirements and killed the rally. In 2011, silver hit $49.80, then collapsed, when the exchange hiked margins 5 times in 9 days. Those were price manipulations, rule changes designed to break momentum. This was something else entirely. The exchange hadn't changed any rules. Margin requirements stayed constant. Leverage limits remained unchanged. Yet the gap persisted and widened. By 10:18 a.m., the spread between COMEX screen price and physical dealer quotes hit $6.10. One London vault operator noted, "In 80 and 11, they killed demand by making it expensive to hold positions. Now demand is killing supply, and there's no rule change that fixes a shortage. The system isn't being manipulated this time, it's being exposed." The paper promises made over decades are meeting physical reality, and physical reality doesn't care about contract language or exchange regulations. Dealer inventories told a story the futures market refused to acknowledge. Major online bullion retailers, 100-ounce bars completely sold out. 1-ounce rounds backordered 6 weeks. Government-minted coins showing call for availability across product lines. Meanwhile, COMEX open interest sat at 175,000 contracts, each representing 5,000 ounces. That's 875 million ounces of paper claims against registered inventory of 100,000 ounces. The ratio, 8,750 to 1. Let that sink in. For every physical ounce available for delivery, there are 8,750 ounces worth of paper promises outstanding. One institutional buyer reported waiting 90 minutes just to get a quote on 10,000 ounces. And when the quote came back, it was $38.50 per ounce with a minimum 4-week delivery window. The screen still showed $33, a $5.50 gap for something that theoretically should price identically. This isn't market inefficiency. This is a fractional reserve system realizing it's fractional. And dealers watching their inventory vanish are refusing to honor screen prices they know don't reflect scarcity. By 10:35 a.m., the arbitrage failure became the story. Arbitrage traders make money by buying low in one market and selling high in another. The spread should never exceed transaction costs for long. Here's what should have happened. Buy COMEX futures at $33, simultaneously sell physical in Shanghai at $38, pocket the $5 difference minus shipping and insurance. Clean, mechanical, risk-free profit. Except it wasn't happening. Why? Because COMEX couldn't deliver the physical metal needed to complete the trade. Shanghai buyers wanted actual bars in vaults they could inspect. COMEX offered cash-settled contracts and registered inventory that had already been claimed by other longs. One Singapore desk reported, "We tried to execute the Arbi, bought 50 contracts on COMEX, contacted 3 Shanghai buyers. All 3 wanted proof of metal in hand before pricing. We couldn't provide it. Trade died." The arbitrage mechanism relies on fungibility, the idea that a COMEX ounce equals a Shanghai ounce. That assumption just shattered. Paper silver and physical silver had officially become 2 different assets trading in 2 different markets. The physical market reality showed up in premium explosions. Normal premiums on 1-ounce silver rounds, $2 to $3 over spot. By 11 a.m. Eastern, dealers quoting $8 to $10 premiums when they quoted at all. That's a 300% increase in transaction costs in under 2 hours. One major U.S. dealer posted, "Due to extraordinary market conditions, all pricing is by phone only, no online orders." Translation: "We don't know what this metal is worth because we can't source it at screen prices." COMEX registered inventory, metal available for immediate delivery, dropped another 15,000 ounces as holders withdrew to private storage. The remaining 85,000 ounces stood against 175,000 open contracts. The ratio worsened to 10,294 to 1. Meanwhile, physical buyers who'd been waiting weeks for delivery received emails. "Your order has been delayed indefinitely. We are working to source metal." Indefinitely. That's dealer speak for, "We sold you something we didn't have and we can't find it." If you're holding a paper position expecting to convert to physical, you might not be able to get what's quoted on your screen at any price. While COMEX showed relative calm, Shanghai physical market was on fire. Shanghai Gold Exchange closed its morning session with silver at 285 yuan per ounce, equivalent to 39.20 USD. COMEX screen price, 33 to 10, a $6.10 gap between East and West. That spread should trigger massive arbitrage flows. Western sellers shipping metal east to capture the premium. Instead, shipping data showed the opposite. Shanghai vaults reporting outflows, London vaults showing drawdowns, New York dealer inventories depleted. Metal was moving west to east in private deals, but those deals were happening at Shanghai prices, not COMEX prices. One Hong Kong trader explained, "Chinese buyers won't accept COMEX settlement. They want serial numbered bars and allocated storage. The premium isn't a premium, it's the real price. COMEX is the discount market for people willing to accept cash instead of metal." The divergence wasn't a mispricing. It was the market bifurcating into two tiers: paper, cheap, available, won't deliver, and physical, expensive, scarce, actually exists. And the gap between those tiers was widening by the hour. The supply-demand fundamentals made the crisis inevitable. Global annual silver mine production, approximately 820 million ounces. Industrial demand alone, 550 million ounces used in solar panels, electronics, medical equipment, batteries. Add investment demand, 200 million, jewelry, 150 million, and silverware, 50 million, and you're at 950 million ounces of total demand against 820 million of production. The market runs a 130 million ounce annual deficit filled by above-ground stockpiles and recycling. Now layer on a sudden investment rush, just 1% of global equity portfolios allocating to physical silver equals 400 million ounces of new demand. The math breaks immediately. One mining analyst noted, "You can't print silver. You can't create it with monetary policy. You either dig it out of the ground or you don't, and we're not digging fast enough." COMEX and LBMA have been papering over this deficit for years by issuing contracts against the same physical ounces multiple times. Fractional reserve banking for metals. It worked fine until people started asking for delivery. Now the fraction is being exposed and there's not enough metal to honor the promises. By 11:15 a.m., forced delivery pressure was building. March silver contracts, set to expire in 2 weeks, showed delivery requests already exceeding available registered inventory by 40%. COMEX rules allow cash settlement when physical delivery isn't feasible, but here's the trap. Settlement happens at the COMEX price, not the physical market price. Screen shows $33. Physical costs $39. Difference? $6 per ounce. If you hold a contract for 5,000 ounces expecting delivery, you get $165,000 in cash settlement. Then you go buy physical at $39 and pay $195,000. You just lost $30,000 on a delivery that didn't deliver. One futures trader described it. It's like ordering a car for $30K, the dealer can't provide it, gives you $30K cash instead, then you find out cars now cost $39K. You're not whole, you're $9K short, plus you still don't have a car. Multiply that across institutional positions, and you're looking at hundreds of millions in forced losses. The paper market offers no deliverable metal, only cash compensation at prices disconnected from reality. And every cash settlement creates immediate buy pressure in the physical market, driving prices higher, widening the gap further. Gamma pressure amplified the squeeze dynamics. Options market on silver showed massive open interest in call options at $35, $40, and $45 strikes. As spot price pushed through $35, those calls went from out of the money to in the money. Market makers who sold those calls naked, without holding the underlying silver, now faced delta hedging requirements. They had to buy futures to cover their exposure. Here's the doom loop. Rising prices force market makers to buy futures, which pushes prices higher, which forces more hedging, which drives prices even higher. one options desk reported, "We're seeing 10,000 contracts of $40 calls go in the money. Each contract requires hedging with underlying futures. That's 50 million ounces of buying pressure hitting a market with 85,000 ounces of deliverable inventory." The math is insane. Gamma squeeze mechanics don't care about fundamentals. They're purely mechanical, algorithmic, forced buying regardless of price. Short sellers who'd been betting on lower prices now faced margin calls, brokers demanding more collateral, accounts getting liquidated. One institutional short described it as watching a tsunami approach in slow motion. You know what's coming, you know you can't stop it, and your only choice is how much you lose before you capitulate. Lease rates revealed the hidden stress. Silver lease rates, the cost to borrow physical metal, spiked to 12% annualized by noon Eastern. Normal lease rate under 0.5%. A 12% lease rate means there's virtually no metal available to borrow, and what exists commands catastrophic premiums. Short sellers who'd borrowed silver to sell, expecting to buy back cheaper, now faced forced buybacks at rates that guaranteed losses. The math: borrow at 0.5%, sell at $30, plan to buy back at $28. Instead, lease rate hits 12%, spot price rises to $35, and you're forced to buy back at higher prices while paying 12% annual interest on metal you can't even source. Some shorts couldn't close positions because there was no physical metal to return to lenders. Exchange notices went out. Failure to deliver will result in forced cash settlement plus penalty. But forced settlement at what price? COMEX says $33. Physical market says $39. The 18% gap meant shorts were getting destroyed regardless of which price applied. Backwardation deepened, near-month contracts trading above distant contracts, signaling immediate scarcity. This wasn't technical noise. This was the market screaming for metal now, not later. Geopolitics entered the equation and accelerated the crisis. Russia announced export restrictions on strategic metals, including silver, citing national security and domestic industrial needs. China's Ministry of Commerce released a statement emphasizing resource sovereignty and strategic commodity management. India raised import duties on precious metals by 5%. Suddenly, this wasn't just a market squeeze. It was nations locking down supply. Western paper markets relied on global metal flows to maintain the illusion of deliverability. Cut those flows, and the fractional reserve system collapses faster. One geopolitical analyst noted, "When countries start hoarding commodities, it's preparation for currency instability or conflict. Silver is money, industrial input, and strategic reserve. They're not letting it leave." COMEX registered inventory dropped another 20,000 ounces overnight as international holders withdrew metal to sovereign vaults. Remaining inventory, 65,000 ounces. Open interest, 175,000 contracts. New ratio, 13,461 to 1. The global squeeze was tightening, and geopolitical controls were cutting off the pressure relief valves. Physical metal wasn't just scarce, it was being strategically sequestered by nation-states who understood the paper game was ending. By Friday afternoon, the endgame mechanics were clear and brutal. COMEX registered silver inventory, 65,000 ounces. Open interest, 175,000 contracts representing 875 million ounces. Ratio, 13,461 paper claims per physical ounce. Physical dealer premiums, $12 over spot. Screen price, $34. Physical price, $46. The divergence hit 35%. One vault operator reported, "We have clients offering 50% premiums for immediate delivery. We have nothing to sell them." The system couldn't reset because there's no mechanism to force sellers to deliver what doesn't exist. Cash settlements continued, each one confirming systemic failure. March contract holders faced a choice: accept cash at paper prices and watch purchasing power evaporate, or try to buy physical at premiums that kept climbing. Either way, losses were locked. Industrial users, electronics manufacturers, solar panel producers started securing off-market deals directly with miners, bypassing exchanges entirely. One procurement officer explained, "We can't risk our production lines on COMEX promises. We're paying premiums but getting guaranteed metal. The exchange can't guarantee anything anymore." The paper market was losing institutional credibility in real time. The weekend brought no relief, only calculation. Markets closed Friday at 5 p.m. EST, with silver futures at $34.20 and physical dealers quoting 47 plus for immediate delivery. The 1280 gap represented a 37% premium over paper. Sustainable? Absolutely not. But closing it required physical metal moving from wherever it was hidden to wherever it was needed, and that metal either didn't exist or wasn't for sale at any price. Backwardation persisted through the close, March contracts at $34.20, June at $33.10. That inverted curve screamed immediate shortage. Lease rates stayed elevated at 11.5% annualized. Inventory remained at 65,000 ounces. Over the weekend, risk managers at banks and brokers would run stress tests. They'd calculate exposure, margin requirements, worst-case scenarios. Some would decide to exit positions Monday morning regardless of cost. That forced selling would hit a market already stretched thin. One London trader sent a message Friday evening, "Monday open is going to be biblical. Either the gap closes violently or the paper market admits it can't deliver. There's no middle ground anymore." The final data point closed any doubt. March 17th, 9:30 a.m. EST, Monday morning open. Silver futures gapped up 320 at the bell, opening at 37.40. Physical dealers immediately adjusted quotes to $51. The premium widened to 1360, a 36% gap. COMEX registered inventory 58,000 ounces after weekend withdrawals. Open interest 172,000 contracts. New ratio 14,127 to 1. In 72 hours, the paper market had lost all pretense of deliverability. One exchange official, speaking anonymously, admitted, "We're in price discovery now. The old pricing mechanism is broken. Paper and physical are separate markets." The spread that opened at 520 on Friday morning now stood at 1360. The system that was supposed to arbitrage it never showed up because it couldn't. Watch the registered inventory, watch the open interest, watch the premiums. This isn't speculation anymore, it's math. The fractional reserve system in silver just collided with physical reality, and physical reality doesn't negotiate. The system's only moments from the edge. Pay attention. The next moves will dictate everything.